Welcome everyone for today's webinar on cracking the code of quant trading competition with Vaibhav. So let me just introduce Vaibhav. So Vaibhav has won IQC 2023, which is conducted by WorldQuant. He was global rank one. He has also won Quant Quest, which was organized by Algobulls. He's currently a student at IIT Bombay, IIT Delhi, and he's also founder of Artificial Intelligence Society of IIT Delhi. And today Weber will be covering how to prepare for these competitions, what are things should look into, and he will give a lot of examples on covering different various type of competitions which are there and how you should approach them. So Weber, you can start.
Yeah, so am I audible, visible,
Yeah,
everything
Weber,
is all
you're
right?
visible. Yeah, yeah.
Sure. So how is everyone? Just for a head start, can you ping your locations or any quick questions so that we can start with that? Great. Can see, many diverse places. Great. Great.
कोड बघितलंय का?
Okay. So love to see you guys. I think everyone. I'm also excited for the session. I have curated a lot of good content so that I can deliver. Of course, the time is limited. I have only 1.5 hours close to that, so I'll try to cover most of it. And otherwise, I'm open to questions. I can ping you my email ID. You can ask questions there. So thanks, Tribhuvan, for a quick introduction. So this is few of my interests specifically in this field. I'll start. So of course, if anyone missed it, kindly do it. Tribhuvan, can you ping this code in the chat as well, so that someone who joins later can do it?
Sure,
Yeah,
Weber. Yeah.
sure. I think I can give you 30 more seconds. Sure, if someone still missed it, do ask me later on. Sure. So just for a quick head start, just to understand how quant competitions are different, if you have anything in your mind, do ping me. Okay. Okay. Interesting questions. Answers as well. Yeah, quant competitions are directly related to market movement. Yes. Few of them are about infrastructure on which the trading strategies are run. But yeah, it is more or less related to market movements. Yes. How it is different? How it is different from an hackathon? So yeah, it is different because hackathon is sometimes built. Of course, there are many types of hackathon which are built on pure dummy projects, in the sense you have a problem statement which won't be used in production, or you won't be used directly by a company. But quant competition is directly related to your PNL. PNL is profit and loss. So so whatever you do, if it is generating profit in the real market, that's the real strategy you have to go with. And quant competition are the direct simulation to that. So that's the usual infra. So usually there are two types of competition. First would be the strategy based competition, in which more or less it is related to directly the strategies that will be deployed in the market. And second would be the infra based. So you have a strategy, you can fine tune it, you can build something that improves the performance of it. And there are a few strategies for the infrastructure as well. So if let's say a few HFT strategies are there, few MFT. So what is HFT? High frequency trading. And what is MFT? Is mid frequency trading. And what is LFT? It's low frequency trading. So all types of infra, so all types of categories need different infra. So that's why each competition brings its own accents to it. So that's why it's unique as well as special. So that's why I think nowadays all the quant companies, of course, one part is just the cash prize. Of course, every quant company organizing this competition have an FT cash prize as a default, but some of them are also using it for recruiting as well. So that's the nice part for quant competitions. Sure. So let's start with the first part that we quoted, right? The strategy part. So alphas, what is alpha? Alphas are mathematical models which directly are traded into the market. Sometimes they are clubbed together and build a super alpha, which are again traded in the market. So there are many types of alphas. So this alpha is used by different competitors. Some use it directly, some use it in the club format. So what there are many approaches, but these two approaches which I quote is usually the most famous one, and I also use both of them. So the approach one usually starts with a trading intuition. You have a trading intuition in your mind. You have few analogy in the sense you have X data, you have Y data. You want something like that predicts that Z. Z is the movement of that price action. So you have a trading intuition, and then you search for the possible data sets. So a trading intuition can be a one-liner, a paragraph, or anything that comes out of your thought. And then you search for the possible data set you have. So of course, every trading intuition cannot be converted into a strategy because the data set would be very costly in the sense. Let's say you have some strategy based on sentiment data. Sentiment data is very precious in the sense if you need a very pure data in the sense it contains no bias, it has representation of all. I'll discuss the sentiment data specifically at the later part of the webinar as well because it has a few more catches. So you get that possible data set and then you search for different implementation of the same in the sense you have a trading intuition. Now you have searched for, let's say, these 5 data sets, time series data sets you can have, cross-sectional data set you have. So you have those data set and then you search for what type of models that can so what type of models are sufficient for these data sets that can be trained. So that comes under the implementation part. And then you get on to the optimization stage that you already have a model freeze, you already have a data set freeze, and you have a trading intuition. Now you search for what type of optimization you can do so that it gives you the best sharp, it gives you the best PNL, it gives you the lowest drawdown. So if these terms are clear to you, I can brief a little bit. So Sharp is basically in easier language. It is volatility of PNL. So less the volatility of PNL, it is better for your strategy in the sense it has least drawdown and the PNL. So PNL should be higher. So of course, few of the strategies have higher Sharp. Sometimes few of the strategies have higher PNL, but can be compromised on the Sharp level. But of course, both of them are important for a strategy to be deployed in the market. So approach two is the other way around. So you have an interesting data set. So you have a very good data set which no competitor have, or your quant researcher, let's say two quant researchers have to build a strategy. So let's say one get an access to a data set and one didn't. So of course, access to a data set or a unique data set is the competitive advantage every quant search for in the sense if someone has a data set and someone don't have the strategy, then that market is an open playground for that QR to make strategy on. So let's say you have a data set X. So then you search for the related data feeds in the sense. So particularly, let's say sentiment data set is what I'm talking about. So then there are many subcategories of that data set. So sentiment is a very broad topic in the sense it has different type of subcategory. I can quote one. Let's say sentiment volume can be one. Sentiment score can be one. So say what is so I think the name is quite explainable in the sense sentiment score. What is sentiment score? It gives you a direction of a sentiment in the sense it can be a positive sentiment, it can be a negative sentiment, it can be a sentiment full of excitement, it can be sentiment full of disappointment. Maybe the market was predicting that something will good some good thing will happen to the company, or maybe the management will change, but sometimes this is a disappointment that the management stays for the next quarter as well. So these types of things happen. And of course, if there is a company with low sentiment volume, uh, like the volume in a sense, of course, every trade you put is accompanied with the volume of that stock, right? So if the volume is very low and if the sentiment volume is also low, so you try to make a decoupling strategy so that you are able to evaluate that volume correctly. In the sense, if the volume is very high, so it should be with the threshold. In the sense, volume. So volume is an absolute term. So volume can be very high, volume can be very low. It should be compared with the threshold. So that's why it is important to evaluate and normalize it at every end. And then after getting all the data fields, you come up with a logical way to trade with all the data set you have. And then, of course, the optimized stage remains the same. In the sense, you have to optimize on whatever factors you have. In a sense, you can improve on the shaft, you can improve on the PNL, you can improve on the drawdown, you can improve on the margins of your strategy so that it can be fitted in the an HFT sector, it can be into the MFT. In a sense, MFT usually need a higher margin because otherwise that skin in the game won't be very less. So if the margins are too low, then a competitor will try to fit that strategy into an HFT one because HFT usually have low margin strategies. Uh, After the detailed explanation on how to build a strategy, I'll go on to a question to everyone. According to you, what kind of data exists with the quants? Because we were discussing a lot about data sets. Uh, uh, I think you can answer it on chat as well. You can answer it on Slido as well. Okay. Price, okay. Time series, okay. Okay, unstructured, you can say, yeah. Volume, of course, volume. We already discussed a lot about volume. So yeah, volume is there. Sentiment, of course. Block deals, of course. News, great. Okay, price volume data set. Okay. OTC contracts. Okay. Fundamental data set. Great. Twitter feed. Twitter feed would be an unstructured way of a sentiment data set. Of course, right? Options data set. Sensitivity data set again. Okay. On Slido. Option depth. Okay. Great. Exchange data. Okay, great. Pretty good. Hmm. One interest. Okay, great. Analyst. Okay. Yeah, analyst is also a very broad thing, like sentiment, in the sense you can have many things that can be categorized into analyst data set. Stock pairing data set. Okay, yes, you use it in pair trading as well. Sure. So let me give you the. So I think the major thing or the basic one is the price volume data set, right? So what does price volume data set usually include? So very easily available. These are open, close, high, low volume. So are they enough? So it is not, of course. There are many data set. So financial data set are much more than we think. It has liquidity, it has price volume, it has earning data set, it has volume weighted average data set, macro data set. So macro is also again an umbrella. So you have volatility data set, you have insider data set, you have fundamental data set. Of course, that I think one of them already covered. Institutional ownership data set, you have sentiment data set, of course, already discussed. Order book data set is very diverse and depth. So one of you, I think, discussed option depth. So you can go on to bifurcating it into multiple things. You have chain, of course, you have tick data, of course, everything, every data set will have can be go on to tick by tick data as well. So as you go on to horizontally making it diverse and as well as vertically as well. So there are diverse data set. So I think most of you know all these data set, or you know 50% of it, or less than that. Okay, 80% good. Because some of the data set need a lot of study. In the sense, of course, analyst is sometimes uh, very friendly enough. In the sense, analyst is if somebody tried to learn analyst data set, you can understand it by the nomenclature, but sometimes an volatility data set is difficult to understand. So that comes with experience, but just for an head start. Hmm. Okay, 25. Okay, so you have to understand a lot more. Sure. I think with data set, so there here comes how you include all the data set into a strategy. Let's say you have to build a strategy and you have the access to price volume data set and fundamental data set. And let's include one more. You can have news data set as well. So you have three types of data sets. So price volume data set is usually, or the news one is usually the data set which change very often. It change tick by tick, in a sense. Every day you have a different set of data. But fundamental data set, of course, there can be one fundamental ratio which may be projected or forecasted every day, but usually it is called as the annual report data set as well, which usually you get at end of a quarter. So these are two types of frequency. In the sense, fundamental you will be getting every quarter, price volume and news you will be getting every day or maybe every tick by tick. So these are the different types of data set you have. So you can have a quarter by quarter data set, you can have a day by day data set, you have tick by tick data set, and you all can also have an annual data set. So having a strategy with an amalgamation of all of them is a challenge, in the sense you can't have a very high frequency strategy with just the fundamental data set. Of course, there can be a possibility that you only forecast it, but of course it's tough. So that comes with how you use all of them together. So then you can say that fundamental data set you can use to get to a decision. In the sense, fundamental decision will a fundamental data set will help you take a decision, like whether this stock to be selected or not, and then price volume and news data set will help you how to trade with it. In the sense, you can have two components of your strategy. In the sense, first would be the stock selection and second would be the momentum. So first would give you what set of stocks you need to select, and you have to give the weights to these stocks. And second would be the momentum base, that whatever uh, fast moving data you have, how much momentum it is able to generate. What So let's say it can be a 5% plunge, it can be a 2% plunge. So these types of calculation can be done to build a strategy. So with this data set, of course, the diversity you can already see, and it's only maybe 5% of what exists in the real market. So I think with all this data set, there is an arise of machine learning as well. So we will understand what is machine learning. I think it's already known to you guys, but how it is used in financial markets and how it is used very carefully, and someone using it day in and day out, but still not making money. There are many challenges to the same, because every data set does not have to be trained with ML. So that's a difference, because sometimes everyone thinking about machine learning thinks like it is just a mathematical model, which is a great explanation. It can be a computer science student can get it just as training all the nodes. Statistical also a big fan of machine learning and also a big hater of machine learning as well, because they think it is overfitted sometimes. There are many controversial statements to the same, but so what is machine learning and its need in finance? Of course, a basic student would be limited to ChatGPT, but it is much more than that. Its existence is much before that. So machine learning, as if someone don't know, it's just a field of artificial intelligence that brings revolution in the data field. And of course, it's a study of statistical algorithms, but there is much more than that. So every approach which has a lot of data can be categorized and can be easily analyzed through machine learning. And with the advent of data and lot of data, deep learning came into picture when we are facing the world of complex data sets as well. So the rise of ML in quantitative finance, sometimes it is called as black box predictor, because someone using it complicated so much that even the quant researcher don't know that what's the output and how it is correlated with the input. In the sense, the input and output mapping is quite tough. So that's why that challenge is also there. So of course, the usage of ML sometimes in the quant industry, especially, is driven by the FOMO it has. In the sense, it can be due to the outperformance of the hedge funds or of the algorithmic trading firms, many HFTs as well. Like they have to outperform the human traders. So sometimes they tend to use it partially, in the sense, of course, maybe the final decision is made out of statistics, but the few of the factors that impact that strategy is used is using that ML black box predictor. So of course there is both pros and cons to it. So I think let's discuss one of the pros followed by a con as well. So there's a very good study done by Two Sigma. I have taken many bits from that, and of course there are many things outside it. So we can get an example. So it's time series analysis using RNNs and the challenges accompanied with it. So one of the challenge that usually everyone face is vanishing and exploding gradients, especially in RNNs when basically, there are two types of things. So ML is useful for large data set, I agree. But for financial data set, sometimes it is not just depth of data, because sometimes you have very less data in finance for whatever strategy you are making. Every category have a lot of data. That is not true. Every data has a lot of depth. That is fine. In the sense you can earn a lot of insights from the particular set of data. That is a good thing. But lot of data required for ML, sometimes it's not sufficient enough. So that's why problems like vanishing and exploding gradient happen, because sometimes the trend in the market is not very short term. In the sense, it can be correlated with something that happened many years back or maybe many days back, according to the frequency of the strategy. So this type of thing happens, so that your gradient that you're using, so it sometimes vanish or sometimes it increases drastically. So then there is some solution. Of course, it's not the only solution, but you use then variants of RNNs that uses memory from a long back. So you use LSTM, and then you also use one one second. My screen stopped.
I think Webo, the screen stopped sharing, I guess.
Yeah. I'm sharing it again.
Yeah.
Any questions? You can keep on writing in the slide. Is my screen visible again?
Yeah, Webo.
Sure. So we were on this. Yeah. So we understood how the vanishing and floating gradient affect our prediction. So then second problem sometimes is that financial data set is not at all stationary, in the sense there are no patterns. In the sense it can be trending. So you have to convert it into stationary data set. So of course, easy solutions are just apply differencing, and that trend will be converted into, you have a stationary mean or variance. Of course, because mean financial data set, if you see price volume data set, a very easy one, your the price of the stock keeps on increasing, or maybe it keeps on increasing and then sometimes decreases. So there's no fixed mean. So then you have to apply so all the stationary stationary statistic formats you have to apply differencing to them. Maybe you have to apply concepts like retrending. Then you have to use some external features that can be used so that you can apply to those non-stationary data. It's very diverse, but this is one of the challenges you usually face in financial data set. So of course, the third, overfitting. Overfitting happens everywhere. I think it's not only to the financial sector, but of course, there is a chances that you have low data set, but you still use a very complex ML model to it, so it overfits, because sometimes you keep on training the same limited type of data set, and your model becomes very complex, and it overfits to those data points. And of course, computation is also one of the them. So there are a few strategies to overcome. So this is one of the challenge that ML may sound pros to it, but it has many cons to it. So let's understand limit order book. So of course, it is used in many competitions. So just to give head start for the same. So you have limit orders. So so you already know there is demand and there is supply. So there is a bid range, in the sense if someone want to buy at 9.98, there's so I'll take the example that I'm showing. So there are in this picture, so there are 9.98, 9.99. So these are two prices that everyone wants to buy at. So there are 100 orders that someone want to buy at 9.98. There are 200 orders that someone want to buy at 9.99. Similarly, other sell side as well. So what you can see is if someone wants to buy at 10, so he has to put, and currently at 10 no one is buying. So if no one is buying and I put an 100 order to it, let's say, okay, I don't have that slide, but if let's say I put 100 order, I have to buy at 10, so it will create a bid over this. And if someone was at a selling party, so he will be available to sell it. So basically you need a counterpart to sell your orders. So or buy, or of course the other way around as well. If you want to buy, there's someone to sell. So it's a two-fro thing. So the lowest price for a sell order is the best ask price. So if someone wants to sell their order, they will bid, of course, in the sense that all the prices would be there, and the lowest of the selling would be the best ask price, and the highest of all the price, all the buy order would be the best bid price. If someone puts a market order, then if he's selling something, so he will sell at this. If he's someone wants to buy it, so he will use these 800. So maybe if someone wants to buy 100 orders, so that 800 will be consumed and make it to 700. So if let's say someone wants to buy, so someone put a market order. Market order is just buy 10, 100 orders. I don't have any limit to it. So that's why. And these are the limit orders that are already placed. So if someone plays in 100 units as a market order, automatically these 200 will be directed to 100, and at he will buy, sorry, he will sell at 9.99. So that is the thing. So and now the other way around. So these are the orders that keeps on. Can you check the edit part? Yeah. So the orders keep on getting submitted, keep on getting cancelled, keep on getting executed. So if let's say there is a new order at 100, in the sense someone wants to buy at 100, so his or her entry would be getting into that array already. So it's there. Now let's understand the limitation to it. So of course, it's not very common because sometimes the bid and ask price are maintained very carefully by the HFTs and the hedge funds of the world. But few of the arbitrage we can see already, in the sense there is a limitation to it. Let's say I want to buy something. So as I said, so there should be someone selling it, right? So if you see this before that -100, if you want to buy something, you will buy at 10.01, and something out of this you have to get, right? And if you have a quantitative quant trading strategy, like the market will increase, so you buy, right? So you are able to buy those 100 quantities, and the price, your prediction is the price will rise, so you buy at 10.01. Price does rise. So if let's say price does rise, in the sense, how will price rise? So there is more demand to buy at higher and higher prices, because these guys were sitting, no one was getting these orders because no one executed this. There are 1,000 orders. Then someone tried, because as you are a great QR, you predicted that price will increase. So you waited, and then there is someone who bought 100 orders of it. So now the price increased, but your buying price is so high that you are still in loss because you are able to get 10.01. We are talking into decimals now. It's not that you are going on, in the sense it's 10, it can become 15, because usually QR work in a very statistical way. In the sense, it can be a very low frequency strategy, but if we see this limitation, because every order book will be in decimals. So 10.01, if I'm the is the buying price, and if I have to sell right away because the price increased, I have to see this spectrum. What is the latest? What is the highest price that I can sell it in? It will be this, right? So, but you sold at 100, and but you sold at 100, but you sold at 10, the 100 quantities, and you bought 100 quantities at 10.01. So there is a fixed loss of -1 still there. So that's why there is a limitation, and that's why these types of strategies are built very cautiously, in the sense there could be a fallback to it. Okay. Questions. Yeah. So there are good ways to reduce noise as well. In the sense, there is averaging. I mean, you can have price averaging. You can increase the delays of your data. You can what you can do. One thing is you can have some checks on the outliers. So of course, sentiments have a lot of outliers. You can put a cap to it. You can categorize it well. Book suggestion, yes, I have it in the end. Books, yes, I already have answered that question. Okay. Optimal batch size, okay. Of course, the batch size you can select according to the computation power you have. And of course, how to handle NAN? Yeah, so if let's say, so in the real market, and you don't have the access to data for every stock. Let's say your universe is 3,000 stocks, right? But your data could have a coverage of, let's say, 73% or 70%, or let's say you only have 2,000 stocks which have a time series available, and the rest of the 100,000 stocks have no data set. That is NAN value. So what you can do is, because if you don't handle it carefully, they will throw. So your strategy will throw random values to it because NAN is nothing for your strategy, right? So you can classify it well, in the sense you can normalize it based on that NAN values, or you can have a pair trading. So you can bifurcate. Of course, it depends on the infra you have. So what you can do is your strategies, which you have thought on, in the sense you can be applied to those 2,000 stocks you have, and for the remaining 1,000, you can still have a working strategy which gives no profit or no loss kind of situation, so that it does not draws a loss to your main strategy PNL. So these types of strategies keep on optimizing. So that's why there's a step called optimize at the end of an alpha making procedure. So that is the thing. What you can do is, if let's say you don't have a data in the time series, you can fill it. So backfill is one of the tool that is used. So time based backfill, or cross sectional based backfill. So if someone don't know about it, so time based backfill is, so let's say you had a data 10-year time series is already there. From last 5 days, you are not getting that data. So you backfill it with the average, or maybe the last time series data you had. So maybe the -5 data, you replace it till you get a fresh stack of data. So this is called time backfill. So you can have it in multiple way. You can use averaging as well. So time backfill is one. Cross-sectional backfill could be you already build some grouping. So you have a group. So if you are not accompanying with the data, so you fill it with an average of the group you have selected. It can be a very simple group. It can be a sector, so that you average out that data from that sector to that particular field or data set you don't have that access on that particular day. It can be very complex group as well, in the sense you put a group which have a high earning, in the sense, of course, you can't compare all the banks together in a sector. Of course, there could be some banks who are only working for rural sector, some banks who are only lending money to the top 1% starter to it, and maybe few banks which are government banks which are not directly focusing on the profits. They may be aligning with the government goals as well. So there are many things. So you can club it on the basis of EBITDA as well. There's no sector thing. You club it based on sector and EBITDA together. So there are many types of grouping strategies are there. Okay. So I think this was the thing I wanted to discuss, that if you're making strategies based on order book or just bid ask, so try to keep these types of things in mind, because everything is not available in the market. If you want to sell something at 10, you can't do it because there is no one to give you those 100 units. And vice versa, of course. So these types of limitations are there. Of course, you can put machine learning using order book data. You have time series data. Let's say you used MT is a function of x naught to xt. Xt is the time, and maybe so 0 is minus t to it. So whatever is today's time, you get the t array of the past, and you use it as a memory. Of course, you can increase it a lot. it increases errors as well, in the sense it can increase the complexity of the model, and sometimes it can deviate from your actual prediction. So there are many challenges to it. That is done. There is sentiment analysis. Using NLP is one of the strategies. There are many other you can use. That's an hint. Of course, I think I discussed two ways, right? Sentiment score and sentiment volume. So one strategy could be if the sentiment score is pretty high, but the sentiment volume is not that good. In a sense, your model has predicted based on, let's say, two to three Twitter accounts rather than accessing 2K or 2000, maybe 2 lakh tweets. So there are different types of edge cases to it. I'll discuss it when I will discuss the strategy of it. Okay, so the time has come. So we will be discussing a strategy based on the sentiment data and some backtesting results. So it's similar to what I have discussed, so it will be easy for you to understand. So let's see an hypothetical sentiment strategy. Let's see it is deployed now. So what's the source of an idea? So source of an idea could be fluctuation in the coin currencies like Doge, Shiba Inu, or any cryptocurrency, because they fluctuate a lot, or maybe driven by sentiments. One source could be Elon Musk Twitter handle as well. So this could be one of the driving factor for few stocks. I'm not quoting anything, just a fun part of it. So the hypothesis could be a spike in social media activity about the stock indicates an upcoming strong price movement. So this can be one of the hypotheses. So first implementation, very naive implementation could be if yeah. So one naive implementation could be a social volume is there. You have the access to the data. But if it is greater than the yesterday's social volume, then you enter a position based on the intensity of the sentiment in the market. So that's a plain vanilla strategy, in the sense you have volume. If the volume is increasing, then you check on the intensity part. If the intensity is also increasing, uh, of course, it is very correlated to the volume. Then you trade based on the score. If it is a positive score, then you buy that stock, and if it's a negative stock, you short that stock. So this could be one of the basic vanilla strategy. Then, of course, the graph says it is working decently. Now, your journey towards more signal accuracy. So, how to detect that spike? So, in the hypothesis there was a keyword spike. So, how to detect that? So, one of the vanilla way was just an increase in from the yesterday social volume can be called a spike. But I think that is not the right way, because it's very volatile. It can be 0.1 increase that you can quote as a spike, but it's not. So the first spike gives a good entry point. So we can assume a 40% sudden rise. It can be anything. So basically optimization helps in it. But of course, you don't have to overfit it, since it can be 25 or 28%. That the sudden rise in it will give me a good spike definition. So any number, I think even 50% would suffice. I just quoted 40. So 40% sudden rise will in this volume will be called as uh, the actual spike. So this could be one. So I think after this, so basically I quoted this because best performance happened with these numbers. So key point of this final implementation is you can still define spike in multiple ways. This could be one of the way. You can have even uh, new ways to make it a robust strategy. One of the way could be you put a threshold to the sentiment. Maybe whatever sentiment score you have is between 0 to 1. So zero point 0.5 to 1 is usually a positive sentiment sector, and 0 to zero point 0.5 is usually a negative one. You did it. But then you can increase the threshold. Zero point 0.5 is usually a very border case. You can have a very high threshold to it, in the sense 0.8 or zero point 0.9 maybe, so that you can access to the top 10 percentile sentiment scores. So these types of things you keep on doing, in the sense. And now one of the question was how to remove noise. So this can be helpful, in the sense mean of past X days rather than the delay of the data, in the sense you can't avoid noise, but you can handle it using mean, because let's say you took an average of five volumes in the past 5 days. So this could be one to increase the robustness of the strategy. Sure. A quick brain teaser. Of course, a lot of theory I've already covered. So quick brain teaser. If we have two strategies of 25% annual returns each together, what will be the net? So if you trade both of the strategies together, what will be the net portfolio annual return? So these annual strategies are exactly in the same market, exactly in the same type of stocks, but it is quoted as two different strategies. What is the net portfolio? I think it's a bit tricky, so do put your mind to it. Okay, someone is saying exactly 25%. Okay. It can be more, it can be less, it can be exactly 25. So these are the three options, obvious options. Okay. Just give it a thought. 12.1. Okay. Someone said close to 25. So can you specify it? Close to 25 from 25 plus or 25 minus? Weighted average. Weighted average of what? Exactly 25. Okay. Depends on your RMS. Okay. Depends on your transaction cost. Okay. You can avoid transaction cost for now. 25 plus minus volatility, 1 plus volatility 2. Okay. That's an interesting answer. Less than 25. 24 approx. Okay. Oh, someone quoted 24 approx. Okay. 25. Hmm. Weighted average of the returns. Okay. So weighted average of the returns is 25 plus 25 by 2. So you're saying 25 or what? Okay. Less than 25. Okay. Depends on population. So, okay. Okay. 100 times 25%. So it should be same. Okay. Hmm. And the third rates. Okay, no. So the investment are the same in the sense you have whatever $1 million to 25% one, $1 million to 25% two. So that weights. So whatever you are saying, right? Investments, the weights are the investments. It is the same. Then 12.5. Okay. So if someone's saying 12.5, so if I keep on increasing the strategy in the count, so my strategies will decrease, or my PNL will decrease according to so one of the speaker. Okay. Okay, 25% exactly. Okay. 56.25. Uh, can you quote me the reason to it? How you got to that specific number? Because I couldn't provide a lot more than the information I have displayed. 25% true market condition. Okay. Hmm. Okay. So I think I thought it would be biased in the sense someone would be in the favor of less than 25% or more than 25% with the majority, but I could fight. I think, oh, there is already a fight. 25.
Vaibhav, are we assuming equal weights to strategy or different weights to the strategy?
Equal weight in the sense
Okay.
equal weight in the sense of the investment, right?
Yeah, yeah, weights.
Yeah, yeah, no, it is same. So I have put let's say $X million to the strategy one, $X million to the strategy two, and then I am trading it together.
Okay.
So I'm not favoring any strategy. So these strategies are run together, but their universe are same. So I can add their weights. Okay. Mm. No, run one strategy first and then the second. No, no. So basically, both of the strategies are managing the same portfolio, and of course, the sample size. So in the sense, the sample of the stocks are also same. So both of the strategies are deployed together. So let's say first strategy got all the weights of let's say 1,000 stocks, and the second strategy also got weights for all the 1,000 stocks, and these weights are added, and then a trading module is run, and these stocks are traded. Sharp. Mm, I think there is no information regarding Sharp for both the strategies. It could be same, it can be different, but it is giving me 25% return. So I'm only talking about returns. I couldn't ask for Sharp. So I think, okay. Depends on the correlation. If both capture same market movements, then would be similar. And yeah, I think interesting answer. Yeah, because sure, I think let me explain it in detail. Hmm. So of course, there are many portfolio management theories already available. So managing portfolio with multiple models. So how to merge two or more strategies, or is it altogether necessary? Because there are many QRs. So otherwise, it could be only one strategy hedge fund, right? So and hedge fund is deploying that uh, only one master strategy, and they are able to earn profits while they are working on multiple strategies. So of course, correlation is one of them. I think around 10 to 15% of the chats, I could see correlation was one of the answer. I think now my follow-up question is merging two correlated strategy versus two uncorrelated models. So models of strategy I can use interchangeably. So which is more profitable? I think this should be obvious, but let's see how my chat reacts. Uncorrelated, okay. I think it should be uncorrelated, right? So uncorrelated seems like two different strategies. So of course, diversity and things like unique strategies come into play, right? Of course, correlation word is usually always used in a negative sense. So, and then can you relate this answer to the previous question? So how this uncorrelation or very correlated strategies gives me an answer to my previous question? So, will a correlated strategy will always be responsible for a less than 25, or it will be exactly 25, or the other way around, in the sense, will every uncorrelated would give me, and of course, with some mathematical reason to it, in the sense, of course, theoretically, I can say it should be very uncorrelated. I have two independent strategies. It should be good because it is happening in the real market. Okay. No, the returns are constant in the sense both of them are giving 25% each if I run them separately. But what's the portfolio return if I run both of their weights together? Okay. Hmm. Okay, I think it's time to answer this. Okay. Okay, I can answer. Okay, I'll explain the long short neutral strategies at the end. I'll answer the question first because I thought. Also, everyone knows about long short neutral or they don't have an idea? Can I have that question answered in the chat? Okay. Oh, otherwise, okay. If you don't have the idea to long short or long short neutral strategy, then of course negative weights you couldn't understand. Okay. I'll explain long short neutral first. Of course, I'll answer all the questions that I have asked because I think I have bombarded 2 to 3 questions. I'll answer that. So, but is long short neutral or basically long short? So you have a strategy. Let's say you have 1,000 stocks that you have to give weights to. Weights. What do you mean by weights? Weights is basically every day. Let's say you have $1 million. Not every day you have $1 million. You have $1 million to deploy. Now what will you do? So in a sense, you have stock A, stock B, stock C. It can be real Apple, real Microsoft, real Facebook as well. I'll quote A, B, C, D. So if A, B, C, D you all have, there is a weight, right? It can be a fraction of that $1 million. So it can be 0.1, someone could be 0.08, someone could be 0.01, someone could be 0.2, someone could be -0.01. So basically it's a fraction. The numbers are between -1 to 1, And all these numbers are then calculated, and those $1 million are shared along these parameters. In the sense, if it is minus 0.0001, that means I'm shorting, but I'm shorting in a very low amount. If it is minus 0.9, of course it won't be minus 0.9, because otherwise your strategy is very skewed. In a sense, it is quoting a zero point 0.9 weight out of that 1 million to shorting a one particular stock. So of course
So how
there are
is this capital allocated to a particular stock or something? Is it based on the risk or
based
what?
based on a strategy. In a sense, whatever
Okay,
strategy
okay.
you had, let's say an alpha gives a weight to so gives a weight to the stock based on the data you had. So I'm
Okay, okay.
talking about the inference part. You already have the model prediction. Let's say some sentiment alpha or alpha that I've already discussed, or a strategy I've already discussed. So basically, it said that Facebook will be given 0.01 weight today out of the money I have. Next day, again, the alpha runs. Now the Facebook weight as per my model is 0.02. So in last day, my weight was 0.01 and now it is 0.02. So my trading module should increase those weights to 0.02, and I'll buy that remaining 0.01 to make it 0.02. So every day I have to align my trading module so that I'm able to get to the alpha values, whatever my model says to do it. So I'll do exactly the same thing.
Yeah, yeah. Got it.
So yeah,
Thanks.
so these are the alpha values. So what is long short? So long short would be alpha. So independence is with the alpha. So the alpha can give a positive value, it can give a negative value. Of course, at the end of that, some of the alphas may be giving values in hundreds as well. So I'll normalize it. I'll reduce it into -1 to 1, so that I my trading module. So basically, it can be -1 to 1 or -100 to 100, of course, as per my trading module. So it has the independence. It can be positive, it can be negative. Now, what is neutral? So neutral is you have equal capital in the long and equal capital in the short. So you don't have that difference, in the sense you are getting long more than you are short, because that's why long short neutral strategies are so much popular, especially in hedge funds. Because then sometimes, let's say you are long short neutral on a sector. So basically on a sector, let's say oil sector or maybe banking sector. So you put $1 million to long and $1 million to short. So that ratio will remain. In the sense, let's say your weights are given -1, -0.3, -0.1, and then only zero point 0.1, zero point 0.2. Then all of them are recalculated so that your capital theory you had, right? Equal long capital and equal short capital still exists. So, so alpha can give anything, but then it's your duty to make it long short neutral as per your theory. So that is the thing. I think it would be very much clear when we discuss the example. So let's take an example. You have stock A, stock B, stock C. So weights in the neutral strategy one, so which is 0.7, zero point 0.3, -1. So basically, let's say I boiled down that example into a three stock universe. Initially I quoted 1,000 stocks. Let's take an example when you have only three stocks in the universe. Of course, it's not the case, but let's take it just for the example. So it is 0.7, zero point 0.3, -1. Interesting part to be, it is if I add all of them, it is 0. So that shows it is long short neutral. So you put 0.7 weight to A, zero point 0.3 weight to B, and -1 weight to C. So basically you are long on A with the zero point 0.7 weight and zero point 0.3 weight to B, and you are shorting C with a heavy weight. So that is the case. And there is weights in strategy 2 as well. So strategy 2 gives a weight of -0.4, -0.6, and a 1, which is exactly opposite to the weights by strategy 1. But I already know that strategy 1 is also giving me a 25% annualized return. Strategy 2 is also giving me an annualized return of 25%. So that's where my question was. In the sense, you have $2 million. You had a book size of 2 million, in the sense 1 million there, 1 million there. So net you have a book size of 2 million, right? And in strategy 2 also there is 1 million, 1 million, 2 million. So both of them have the similar book size, right? Now, if so my question was, let's add both of the strategies. So the net weight to the strategy is zero point 0.7. So my strategy 1 wants 0.7, my strategy 2 wants -0.4. I have both of them in the same portfolio. So my net weight would be 0.3. And again, B has 0.3 minus 0.6, again minus 0.03, 0.3, and then C becomes 0 in the sense I don't have to take any weight to it. So that is the case. Now, so how the book size is calculated? You add the mod of all of the three transactions in the sense it could be two. So if I take a mod of it, so it's 0.6. So my book size also decreases. So even if I traded them separately, whatever be my profit is, that will remain constant. But my book size over it, in the sense, if I have a constant book size, initially I had $2 million. My strategy one is only using $0.6 million. I can use the remaining $1.4 million to do something else, maybe an option strategy or maybe anything. But the point is, your profit is calculated based on a profit percentage is calculated based on profit upon the book size times 100. Of course, book size you have to divide by 2 as well, because both on both the side, right? So zero point 0.6 could be the one. So if you're getting the same profit in less book size, your profit share would increase, in the sense it could be, maybe in this case it could be maybe 4 times. So, but of course it differs based on the weights you have. Anything specific here, how these weights are selected, so that I can prove my statement, because I wanted to prove something, right? So I proved with these weights. Anything special in these weights which are different from these, or are they similar in some sense? Okay. Risk rise. Okay. Basics of short. So basically, short is selling first and then buying it later. It's just the opposite of what we do in long, in the sense long you buy first and then you sell. Profit can be large. Of course, in this case it would be, because as I said, profit percentage is calculated as profit upon the book size times 100. So whatever capital you use to earn a profit, that's the percentage, right? So you used book size very efficiently. So initially you were only deploying $2 million and you were earning 25%. In strategy 2 as well, you were using $2 million and you used it and you earned 25%. Now you're using only $0.6 million instead of $4 million to earn 25%. So you are only using 2.6 to earn, let's say, similar profit. So that so in this case, transaction cost is assumed to be 0 and maybe negligible. Okay, kind of opposite. Okay, yes. I think, yeah, I was careful enough. It should be opposite, because I have to prove one statement that I've already quoted, right? Correlated and uncorrelated. I tried my best that these two weights are uncorrelated, and which seems I was careful enough. If you find that a correlation between these two vectors, this is one vector, this is one vector, it would be very uncorrelated. So let's take another example. Again, two strategies, you have weights. So strategy one, of course, it is different from the strategies I've used here, because if I'm talking about the same date, that weights should be same. That strategy two is giving me different weights. This time it's different. So these two strategies are different and these two are different. And it is different in examples apart as well. So 0 0.7, 0 0.3 minus 1. This is 0 0.6, 0 0.4 minus 1. What's the noticeable thing in this example, which was not there in the previous one? Okay, I think it's very easy, because both of them tried to be very correlated. It can be 0.4, 0.6 minus 1 as well. But I gave in 0.6 because my strategy one also gave a higher weight to A than B. So I have also maintained that relation between the stocks as well. It couldn't be only a positive weight to A. It is more weight to A as well. So both of the things, so that I can maintain highest level of correlation. So if I'm able to get that magnitude sum, it is 2, 2. It is 2, 2. And if I get the net weight is 1.3, 0.7, and minus 2. So what's the magnitude weight? 1.3 plus 0.7 plus, of course, plus 2. So it is 4. So now my book size doubled, in the sense initially it was 2, 2. Now it is 4. And of course, not double. If I run both of them independently, it would be 2 plus 2. And now the net weight is again 4. So it can be less than that, maybe 3.6, or it can be more than that, maybe kind of. But I think I was able to explain my concept well. Just an example I've quoted. So in this way, if the percentage I calculate, the denominator increased, but my profit still remained the same. So oh, sorry, my bad. So the book size still remained the same, just my numerator is also same, my denominator is also same. The profit percentage still remained to be 25%. So that's why that aim of getting a less than 25% state couldn't happen. So that's the case. I think many were quoting less than 25. So you already got the answer. Okay, that is it. The example is clear, right? Okay. So now comes to the final slide. So someone were asking about what's the background requirement. Of course, there's no background. If you're interested into finance, and if you're interested into mathematics, you're interested into trading, everything all at once. So that's the skills required for excelling in these competitions. So if someone wants to make money systematically, highly likely that he will do good in these competitions, because that that rigor is required to excel in these competitions. Your experience in finance can be beneficial for you, or sometimes these competitions are well worse for beginners as well. So you only need that curiosity. So experience in finance can be a priority two skill. Trading and investing skills, again, you don't have to be well versed with those trading skills at par. Now, okay. Yeah, you should be good in probability and statistics. I wanted to quote mathematics here, but if you don't want to go to all the mathematic chapters again, vector algebra and all, you can, of course, sorry, vector algebra is kind of very important, but maybe 3D geometry is not important. So good in probability and statistics would be a right way to excel in this. Good
I
in
think,
memory.
well, still someone has to go with linear algebra and calculus at least, I guess,
Yeah,
with
yeah,
group stat.
yeah. So I only quoted few of them. So statistics, vector algebra, and all. Everything is necessary, but I'm not quoting that 3D geometry would be very much useful. Of course, if someone can quote that curves need to be analyzed, that volatility curves, 3D curves are also analyzed. That is also thing, but this could be a good start in the sense you can understand probability, statistics, vector algebra, and then you keep on getting those skills as you get to the problem statement. So you carry all these skills. You should be very good in mental calculations. If you're not, try to work on it. Of course, you should be able to think good in puzzles as well. A good start could be for probability. You can go to these books. You can go to MIT education. There are many great courses in statistics, probability, and vector algebra and other algebra topics. For experience, you can go to WorldQuant Brain platform. It has quite a user-friendly interface. You can go to any competition thereafter and understand this field in detail. So, or for theoretical read, you can read a lot of papers on XRIA or SSRN, or maybe a learn section of whatever competition you are participating. Just go through the instruction first. It can be a great knowledge boost before starting in competition, because they already know that this competition is a smaller version of what they really do in their daily trading practices. So they want to give you a knowledge that helps you directly to excel in this competition. So that will be a good way to excel in these competitions. So learn section of WorldQuant Brain, if you are participating in that, it would be give you a good jump to it. And if you're not, then you can also go through the alpha in general. What is alpha? What is how they're performed, how they're made, how they're usually a lot of knowledge you can get from these sources. I think this was my final slide, I guess. Any questions for me? Don't worry to ask. It is anonymous. And that's a wrap. Sure. Now I'll answer questions.
Could you share the PPT after this webinar?
Sure, I'll coordinate with the Tribhuvan and we can make something out of it. Yeah.
Sure, sure. Thanks.
Okay, can you please from the comment? Robustness strategy, techniques, and evaluation of a trading strategy. Of course, you build a strategy. Of course, there is a bias in the sense these weights I have put. It should be in the OS period. So, what is OS? Outsample period. Your strategy should perform in the test period. If let's say you have built a strategy on 10-year time frame, that will be your in sample testing. Even if you're getting a very good sharp, maybe a 3 sharp, 4 sharp strategy in those 10 years, that does not value to the portfolio managers, because on the testing period, how much your strategy is performing, that affects. So OS period is the good way to judge your trading strategy stats. Other way could be you can have concentration checks as well. In the sense you have 1,000 stocks, your strategy performed way better than any strategy, but your PNL, the profit and loss, is derived from, let's say, 10 to 15% of the universe. So that robustness you can put, in the sense your strategy PNL should be derived from a lot many stocks than those 10%, because those 10% can be overvaluing, what's the correct word to it? Maybe overpowering the PNL than the other losses of the other stocks. Maybe in the OS period, which you haven't seen, those overpowering nature diminishes and the other losses starts to look up. So, okay, best recommendation, I guess. For probability, you can see to these books. There are, of course, these are not limited to these, but there are many good. Okay, best recommendation quant books. I guess it's better to go to the online medium as well, because this world is changing a lot. So you need to be up to date as much as possible. So online resources would be better. You can go to SSRN or many research publications so that you can get to the best or the latest technology or the theory as possible. I'm beginner, so beginner, I think these would be fine. Go to one of the platform, whichever you find user friendly. Try to go through its learn section or any guide it has. Try to participate, and then during this journey, try to learn a lot from different sources, and then get your hand dirty. Good quality data. So I think few of the data. So I think I've already quoted, in the sense like price volume data set, or these type of data sets are already available in the market. In the sense you can download it, it's already open source. Of course, few of the fundamental data you can also access. So every country have a specific market leader in it. So there could be some free resources, there could be some paid data as well. So you have to spend some bucks to it. How can we access? I think Tribhuvan will be the best person. What could be the roadmap if okay. I guess if someone wants to build quant as a career, uh, I think this could be a nice start. You should be good in mathematics. You should be good in uh, machine learning. If not, just statistics also gives a head start. So, and you should be well versed with many specific topics that you study in your engineering mathematics. So that you have to be, of course, interest in finance is a plus. Of course, not a necessary, but nowadays, because the competition is very high, you have to prepare well first. So that's the thing. Which material courses? I think Tribhuvan would be the best person for that, because I think there are a lot of resources. You just have to get your hand dirty and keep on learning, because even if you invest some time on many courses, it gives you some learnings here and there. So that's an add-on. Of course, managing time is a skill that you can only learn when you are investing your time. So try to get to that workload thing. And of course, initially it would be very disappointing, in the sense you are not able to spend much time with your friends, or maybe spend much time in your hobbies, non-academic hobbies, and but then you tend to be good at it. I'm not saying you cut yourself from the world, but just that dedicate few hours to it, because sometimes we kind of give time. No, sometimes we kind of think that we are not giving time, or we are giving a lot of time and just waste our time in overthinking. So that would be uh not the ideal situation, but you have to get away with it. Book suggestion, yeah, book suggestion. I think it is not limited to these. There are many. Just search. LinkedIn could be one. Many, I think, Quant Insider is the one. It has a lot of suggestions, post. Go through it once. Okay.
So, guys, the basic book which you can start with is Algorithmic Trading, Winning Strategies and Their Narration by Ernest P. Chan. That's the, I think there's a best beginner friendly book. They don't have a lot of mathematics like basic karma filter, and then you have other few basics mathematics stuff. So not high level mathematics. Even if you have studied 12th till like J level math or even 12th math and with prop stat, you can go to that book. It's a great way to start.
Hmm. Yeah. Do you also do competitive programming? I did at the initial point, but of course, then of course you can be very good at competitive programming. That can be one key point in terms of recruiters, and of course, it builds your IQ. So you can do it. You can try it out. Pritosh, what's the some literature for medium frequency? I think SSRN would be. I think I've already quoted SSRN very many number of times, but I think for MFT strategies and in general alpha signals, go through SSRN. It will increase your horizon to the world of equities. So and indices, of course. I have learned many things reading these publications and research papers. I think I've read many. It's already in 3 digits. I want to read as many as possible because I think people have put all their hard work to it. So why to go ignore that? So just go on and read them. It's just okay. How did you learn? Of course, it is about these strategies in the sense I've already portrayed. Uh, I think in this, I think these two approaches. Of course, it's a very high level approach, but it kind of helps to structure your alpha making journey. Uh, no question. What instrument do you trade? You were asking for my personal trading habit. I have traded many. Can you get this PDF? Will surely make this happen. Algorithmic trading winning strategies. Okay. EP chan. Yes. I am 10 plus. Okay. What steps to follow to break into bonds? Yeah, surely you will get the recording of the session. Okay, I think breaking into quant. Okay, you are already into analyst. Okay, 10 plus years. I think with my experience, it could be just get some outshining points in the sense do great in the field of quant, and these quants are very much ready to get you on board. But of course, you have to work hard because they have very less positions. How did you manage? Okay, I've already answered this. I think I have answered many. For energy market, I guess you can try studying for energy specifically. I don't have a specific recommendation, but I think energy has its own fundamentals to see. So energy market, try to understand what are the fundamentals that draws from other time series to the energy price time series. So then you can have some correlation between both of them, and you can build strategies on the same. Maybe gold or energy can be correlated, or any sort of thing. You have to try it, and if starts working, you have to then be on a thin line. It shouldn't be very overfit. It should be fit, but it shouldn't be overfit so that it only drives on in sample. Focusing on spreads. Okay, statistical arbitrage. Yeah, I think energy is kind of very interesting. I was also going through it. Recent knowledge, okay. For getting into quant, I think you have to go through that rigorous interviews and eligibility criteria. Of course, being good in quant in the job quant. So then you have to be very curious. Of course, initial knowledge of finance does not matter that much because you have to be very deep in what you do. So getting a superficial knowledge of finance and then quoting it as a knowledge of finance, it's usually not a very good idea. So that is the thing. CP could help in getting into one of the roles. Maybe few companies have very hard DSA test. So then CP could be one, but of course, not all of them have a CP test. Technical proficiency, it can be depending on the roles, of course. If let's say your company is using C++ a lot more, so they can ask C++ stuff to you. Yes, of course, there are chances. There are many good chances. If you're good and you're able to crack the interviews, then of course. Of course, you have to be outlier in the sense if you do what your peers are doing, maybe you're good in software roles as well, but in quant, you have to outshine because if the headcount is less, you have to outshine yourself. And of course, these competitions have a lot of weightage to it. Sometimes your shortlist is driven by these competitions. Sometimes. Sometimes it is GPA centric, sometimes it is department centric, of course, but you can't do it anyway. So you have to focus on those which affects that shortlist. Is IT tag mandatory? No, I think you already, of course, you can say it's skewed, but there are many examples. So you can draw inspiration and you can work on it. I got an offer from them. I think from learn section, apart from learn section, you can, if you want to increase your finance horizon, you can go on to SSRN and other research papers to get on. And I think community section is one. Be with few consultants, few experienced consultants, and then just gets your hand dirty. So that would be the best way. There is no fixed path. If it's a fixed path, then no one will call it as a research, right? It could be a development of strategy. It is about research because it is it is not at all a fixed path that you have to follow. Otherwise, you will build correlated strategies, right? The fun part and the interesting part is you have to build new things every day, every month, every year. Stop working in the next regime. Regime, are you quoting it as a location thing? So in the sense, few strategies work in few global regions. These strategies are not transferable to other region or what? What is the regime? Fang versus quant, I think whatever you're good at. No, for a certain period of time. Okay. I guess that's why you have to increase the backtesting period so that instead of overfitting on a particular regime, you get that diversity in the sense your strategy is well versed with all the regimes, and then you're able to get that same behavior that you got in the example.
There is one interesting paper by EP Chen recently, which is conditional portfolio optimization. You can check that paper. It's on regime switching. So yeah, I think you can check that paper if you want to work on regime switching.
No, I'm lacking my job. No, I'm not in a job right now, but whatever I'll do, I'll try it aligns with my goals. What's the paper name? Can you repeat, Tribhuvan? Pratosh is asking.
It's you can just search conditional portfolio optimization, or if you want, let's just give it. I will just ping in the chat.
Yeah,
It's exactly.
yes. Yeah, it is increasing in India. Quant culture and the quant companies, every year we see an unexpected move that they are increasing their hiring day in and day out. So I'm very bullish on the quant culture and quant roles in India. And sometimes it's not just about job. You can also work as, so basically if I quote WorldQuant here, so if you work as a consultant, I think it's a good, a big money you can make. So that is, you just have to give your 100%, you have to give your time. So that's the key. Paper is already pinged. So which should be followed. I think videos are already there in the learn section. You can go through them. Of course, the community. So one surprising part is the community at WorldQuant Brain has developed a lot in the past 1 to 1.5 years. So you will get very advanced knowledge if you go through the post that are posted by maybe experienced consultants, and that will help you to get a head start. Of course, you have to get your hand dirty, and of course, there is no fixed part, there is no template. You have to get to your own thing that works, and you have to build many of it. In the sense, you don't have to stick to one, because then diversity will be a question. Then if you're making only simple, not simple, but only same strategies. I'm trading energy. Okay. I think Pine scripts are one. There are many startups. I think AlgoBulls is one. AlgoBulls also work on automating strategy for you. Many companies out there. Of course, you have to get to their software first. Into Kaggle competitions. Kaggle competitions are usually crowded with many experienced guy, but of course, why not to get your hands dirty? So get on into it. Of course, you can't always target those top 1 2 3 where the cash prices are, because then they are very accumulated with the experienced one. But you will slowly or steadily you will get to those numbers if you work hard. With these Kaggle competitions, sometimes these firms directly hire, so there is no resume shortage as well. If you do good in Kaggle, or maybe in few of the competitions, not only just on Kaggles, maybe any competitions, of course, Quant Insider, you can get the knowledge of what competitions are happening day in and day out. So you can get to that list, try to excel in as many as possible, and these firms are looking for new talents. I think that's all. Still, if uh, okay, yeah, this is the platform. Oh, Algobles web, yes. I think I could answer all of them, I feel. Any questions? I think it can be routed well through Tribhuvan, and I think we can wrap the
Yeah,
session. Yeah,
so I think, yeah, we are done. We don't have any questions anymore. Uh, so thank you so much, guys, for joining. Thank you so much, Weber, for such an insightful talk. You covered a lot of broad stuff.
I try to, yes.
Yeah, it was great. It was great. You covered everything from NLPs to ML implementation to order books and everything. I think it will be very helpful for people who are going for these competitions, because these competitions does give you chance to get highlighted in front of the recruiter, because if you win or at least come in top 5, you might be able to in notice of the recruiter, so you still have a chance. So uh, doing competition gets you a lot of learning, as well as it give you a chance. So yeah, that was the whole purpose of conducting this, because there's not a lot of awareness about these competitions in India, I think, and it is still limited to top IITs or top tier colleges. So we wanted to know other people as well. That's why we do these initiatives. And Weber, yeah, you covered it very well. Yeah. So yeah,
Sure, I think.
yeah.
Thanks,
Also,
Tribhuvan.
guys, yeah, the recording will be uploaded in our YouTube channel in 2 3 days. So you can subscribe to our YouTube channel. I will just ping the link of our link of the YouTube channel. So you can subscribe that, and within 2 3 days, the videos will be on a YouTube channel, so you can always refer to it whenever you want. Also, we are also putting a new podcast tomorrow with with EP Chan on machine learning implementation and using machine learning for trading. So surely check out that as well, which will be out tomorrow. So I've pinned the chat in the I've pinned the link of the YouTube channel in the chat, so you can check